What is a dividend? Passive income explained. What if your money could work for you while you sleep? That's exactly what dividends allow you to do. In this video, we're going to break down what a dividend is, how it works, and how everyday people use dividends to build passive income over time. What is a dividend? A dividend is a payment made by a company to its shareholders out of its profits. Think of it as your share of the company's earnings, simply for owning its stock. Not all companies pay dividends. Younger, faster-growing companies like many tech startups tend to reinvest all their profits back into the business. But established, profitable companies, like big banks, energy firms, and consumer brands, often reward their shareholders with regular dividend payments. A simple example, let's say you own 1,000 shares in a company and it pays a dividend of 20 pence per share. You would receive 200 just for holding those shares. If it pays that dividend 4 times a year, that's £800 in passive income annually without selling a single share. How often are dividends paid? Most companies pay dividends either quarterly, 4 times a year, or annually, once a year. Some pay monthly. The company's board of directors decides how much to pay and when. What is dividend yield? Dividend yield is a percentage that tells you how much a company pays in dividends relative to its share price. For example, if a share costs 10 pounds and pays £250 in dividends per year, the dividend yield is 5%. This is a key number to look at when evaluating dividend stocks. A yield between 3% and 6% is generally considered healthy. A yield that's too high, say above 8% or 9%, can sometimes be a warning sign that the company is struggling and may cut its dividend in the future. What is the ex-dividend date? To receive a dividend, you must own the shares before the ex-dividend date. This is the cutoff date set by the company. If you buy shares on or after the ex-dividend date, you won't receive that particular payment. So timing matters if you're specifically buying a stock for its upcoming dividend. How do dividends build wealth over time? The real power of dividends comes from reinvesting them. Instead of spending your dividend payments, you use them to buy more shares. Those additional shares then generate their own dividends, which buy even more shares, and so on. This is called compounding, and over time, it can dramatically grow your wealth. For example, £10,000 invested in a stock with a 5% dividend yield, with dividends reinvested over 20 years, could grow to well over £25,000 without you adding a single extra penny. What are the best dividend stocks in the UK? Some of the most well-known dividend-paying companies in the UK include large banks, utility companies, and FTSE 100 giants. These are companies with long track records of paying consistent dividends. Always do your own research before investing, but look for companies with a history of maintaining or growing their dividend over many years. These are sometimes called dividend aristocrats. Are dividends taxable? In the UK, you have a dividend allowance, currently £500 per year, meaning you don't pay tax on the first £500 of dividend income. Above that, you pay tax depending on your income tax band. Basic rate taxpayers pay 8.75%. Higher rate taxpayers pay 33.75%. If your dividends are inside an ISA, however, they are completely tax-free, making an ISA one of the most powerful tools for dividend investors in the UK. Final thoughts. Dividends are one of the simplest and most rewarding ways to generate passive income from the stock market. You don't need to be rich to get started. Even small, consistent investments in dividend-paying stocks, reinvested over time, can build meaningful wealth. At MarketIQBasics, we're here to help you understand every building block of investing. If this video helped you, please like, subscribe, and share. See you in the next one.